Hello, we're going to go over problem 328, subsequent consolidation after the initial acquisition, and during the year the parent needs to adjust its investment account for the subsidiary using the equity method. The original investment recorded at the date of acquisition is adjusted for fair market value adjustments and other intangible assets that are recognized like goodwill initially, and then we have amortization expense. The parent's share of the subsidiary's net income or loss, and the receipt of dividends from the sub. Now, you may wonder, if the problem tells you that Patrick bought O'Brien for $550,000, why is the investment in O'Brien at $680,000 using the equity method on December 31st? Well, we had the January 1st acquisition price of $550,000, 100% of O'Brien's reported income of $222,000 less net excess amortization due to assets being recorded different than their book value with O'Brien, and subtracting 100% of O'Brien's reported dividends. We will review net excess amortization on the next page. So with any of these problems with subsequent consolidations after recording the initial acquisition, you still have to go back to the first day to figure out goodwill unless it's been subsequently impaired. So we need to do goodwill as of the first day of the acquisition. Consolidation here is at the end of the year. O'Brien's acquisition date fair value is $550,000. If we look at O'Brien's book value and subtract it, that was only $350,000 the date of the acquisition, well, there's fair value in excess of O'Brien's book value, and that's why we were willing to pay more. So we would subtract excess assigned to specific accounts based on the fair value at acquisition, trademark, customer, and equipment, and that only accounts for $145,000 of the $200,000 in excess of book value. The remainder, if it's positive, is goodwill. If it's negative, there was initially a gain on bargain purchase. So let's look at those specific assets that have limited lives, acquired in excess of book value, and figure out annual excess amortization. Trademarks have an indefinite life. We don't have to worry about amortizing them, although we would test them for impairment. Customer relationships, $75,000 we record at the initial day, January 1st, has a 5-year life. Each year has an excess amortization, so if we're recording them in consolidation above book value and they only have a 5-year life, we need excess amortization each year of $15,000. Equipment was overvalued on the books by $30,000, so in consolidation we reduce its value. Equipment is overvalued on O'Brien's books. We reduce its value by $30,000 the first day, but we need to amortize that or reduce consolidated depreciation each year by $3,000 over the 10 years. Goodwill is indefinite and certainly needs to be tested for impairment. So in total, we've looked at the price we paid and attributed it to certain specific assets different than book value. Those with limited lives, we have to adjust excess amortization or depreciation in the consolidation worksheet. Okay, without preparing a worksheet, determine and explain the consolidated totals for Patrick and O'Brien after 1 year. We have a 100% owned subsidiary here, a full year after the initial acquisition, and no intercompany transactions, sales, cost of goods sold, receivables, payables. So this should be fairly straightforward. Starting with the consolidation worksheet, it always has revenues, expense, income, and dividends. Revenues, just the parent's book value plus the sub's book value. And we've owned the sub the whole year, so we can take the revenues for the whole year. Same with the cost of goods sold. Amortization expense, we add the parent's and the sub's amortization expense on its books, plus the acquisition-related adjustment of $15,000 from the customer relationship and the equipment. Sorry, from the customer relationship only, because the equipment is depreciation. For depreciation, $142,000, we add both company parent depreciation, subs depreciation, less the acquisition related depreciation adjustment. We feel that the equipment is overvalued on O'Brien's books, so we would reduce the depreciation by $3,000 a year to do so in consolidation. Note, when we're doing journal entries in the consolidation worksheet, we want to eliminate all of the parent's income from O'Brien and all of the separate investment in the parent in O'Brien. So income from O'Brien, once you've added in its revenues and expenses individually, there should no longer be income from O'Brien in the consolidation. Net income, consolidated revenues minus the consolidated expenses. Note, consolidated net income, you can get what it's going to be even though the lines in which things are recorded are different. If we record O'Brien on the parent's books using the equity method, the $935,000 reported in consolidated net income is the same as the parent's net income prior to consolidation, given that we used the equity method to record income from O'Brien. And that's why I emphasize this method for our work. Dividends declared are parent only. The subsidiary's dividends given to the parent, and we eliminate it. What happens with the assets? 100% owned subsidiary, we own it for a full year after the initial acquisition, no intercompany transactions. Cash, you add the two book values. Receivables, add the two book values. There's no intercompany receivables or payables. Inventory, with no intercompany sales or cost of goods sold, there's no adjustments here. Investment in O'Brien is zero. We eliminate it because we're adding O'Brien's cash, receivables, inventory, and individual assets to the individual asset accounts. Trademarks, $634,000. The accounts of both companies are added together, plus the $100,000 fair value adjustment, which does not get amortized. Customer relationships after 1 year, parent plus sub, which there were no relationship assets before this, parent plus sub plus the initial fair value adjustment, less $15,000 amortization at the end of 1 year, December 31st. Equipment, parent plus sub less the $30,000 to write down O'Brien's equipment to its fair value, but we add back $3,000 in depreciation expense for 1 year. Goodwill, $55,000, the original allocation unless there's subsequent impairment. Total assets, $2.8 million. Add the consolidated totals. What happens with liability and equity? Same situation. Liabilities, the parent plus the sub's book value if no valuations above or below book value, and no intercompany transactions. Common stock, the parent's equity section only survives. You can't add Patrick and O'Brien's equity. It's like adding apples and oranges. Retained earnings. Note, even before doing the consolidation, since we used the equity method to account for O'Brien, we could have just taken the parent's balance on 12/31, Patrick's balance on 12/31. So we could have guessed it without even doing all this. And again, it's computed in the consolidation worksheet. Total liabilities and equity, sum consolidated balances. Now if we wanted to do the journal entries for a 100% owned subsidiary, full year after initial acquisition, no intercompany transactions. Consolidation entry S eliminates O'Brien's beginning stockholders' equity against Patrick's investment. Consolidation entry A, recognize unamortized allocation balances as of the beginning of the year. So there was no amortization at the beginning of the year. So the initial values for trademarks, customer relationships, goodwill, and we reduce equipment since it was overvalued on O'Brien's books. So one of the reasons why we have a big investment in O'Brien is not only O'Brien's book value, but assets that are different than book value as of the beginning of the year. Consolidation entry I, remove the equity income accrual based on the subs income, less the net amortization for the equipment and the customer relationships of $12,000 a year. Reduce equity income of O'Brien, reduce the investment in O'Brien. Remove intra-entity dividends. So we'd increase investment in O'Brien because when we reuse the equity method, dividends reduce the investment in O'Brien, and we reduce the dividends declared on O'Brien's books. Finally, excess amortization. For those assets with limited lives, we amortize or reduce the customer relationship asset recognized in consolidation, and we reduce the net book value of the equipment we increase net book value of equipment by reducing the depreciation expense. If you want to do the worksheet, it is on Moodle. You can look at these individual entries in the consolidation worksheet. And that is it. Good luck.